Texas remains the absolute center of home building in the United States, positioning itself as a beacon of growth. But as we approach 2026, we must look past the construction cranes and acknowledge the grim data. This momentum is built upon a foundation of meaningful volatility, threatening to collapse the market under its own weight. The best, and most alarming, description of the current Texas housing market is choppy. We are not seeing stability, we are seeing severe inconsistency, defined by sharp month-to-month swings and differences between regions and builders. Nationally, home price gains slowed significantly, rising only 0.8% year-over-year in November across the U.S. But Texas cities are not slowing down, they are actively declining. The core threat to the Texas housing narrative is the reality that prices are not merely normalizing, they are tanking. According to data from Intercontinental Exchange for November 2025, Austin, Texas, is one of the national leaders in negative price growth. Austin's home prices fell -4.71% year-over-year. This decline places Austin third among the 100 largest U.S. metro areas for the largest price drop, surpassed only by 2 cities in Florida. This is a severe contraction following the COVID-era boom. The current home price index HPI for Austin stands at $459,110. Significantly down from its peak of $588,575. But the crisis is statewide. Dallas, the largest new home market in the U.S., saw home prices decline -2.86% year-over-year. Houston, the second largest market, saw a decline of -2.45%. Even San Antonio, often labeled the state's most stable market, recorded a drop of -2.85%. Overall, 36 of the 100 largest U.S. metro areas posted negative annual price growth in November, and Texas cities are disproportionately represented in this group. When housing prices are falling this fast, confidence evaporates, confirming that market stability is dangerously eroded. This volatility is largely driven by 2 things: crippled consumer confidence and an affordability gap that builders are failing to bridge. Builders are responding aggressively, often buying down mortgage rates or offering heavy incentives just to move standing inventory. While these tactics slightly improve incremental affordability, which can drive mortgage application volumes to multi-year highs, these methods are proving costly. This heavy use of incentives is resulting in significant margin pressure for builders across the board. The market has become so rate-sensitive that hundreds of thousands of borrowers move in and out of refinance incentive with small daily rate shifts. This demonstrates that, while demand can return, when affordability improves, households are watching rates closely because they are already struggling to manage monthly costs and access equity. When consumer confidence is this fragile, any minor economic shock could trigger a full withdrawal of demand, plunging the market into a deeper crisis. Job growth and consumer confidence are the ultimate wildcards. Rate drops alone will not unlock demand unless consumers feel genuinely secure. The sheer size of the Texas housing market exposes it to massive risk. Dallas, despite its status as the top new home market, is exhibiting recent softness. Houston, the second largest market, benefits from massive master plan communities and strong migration. But its very ease of development and lack of land constraints, which fuel high-volume entry-level markets, means it is critically vulnerable to oversupply if migration slows. Then there is Austin, the state's most profound failure point. Austin saw the biggest boom during the pandemic and is now seeing the biggest pullback. The data here is a devastating indictment of overextension. Housing starts are down 15%. Builders, desperate to find a sustainable price point, have had to quickly adjust by offering smaller homes on tighter lots. This scramble for affordability, while necessary, indicates a desperate reversal of years of luxury and high-growth trends. San Antonio remains the outlier, being the only major Texas market where job growth has trended upward year-over-year. But even here, where a majority of homes are priced below $400,000, the deep price declines to 0.85% YoY confirm that no Texas market is immune to the state's overall downward trend. Complicating this crisis is the state's determined effort to attract foreign investment. Texas is already the third most popular destination for foreign buyers. Recent constitutional amendments, primarily focused on taxes, have intensified this appeal. Proposition 2, for instance, which was backed by over 65% of voters, bans Texas from taxing people or businesses on profits from capital assets like real estate. This amendment means that investors, including flippers and developers, can sell property at a gain, without the state taking a cut, offering a huge incentive compared to other markets. This is especially beneficial for investors who build equity through renovation or market appreciation. Other tax breaks, such as increasing the homestead exemption Proposition 13, also enhance investor returns. While experts suggest these incentives might eventually lead to more affordable housing for locals, the immediate risk is severe. The market is structured to reward investors and flippers at a time when ordinary Texas households are struggling with affordability and economic insecurity. This dual reality momentum for investors colliding with price collapse for average citizens is creating a time bomb. If these investors suddenly decide to liquidate, Texas could see a devastating inventory spike, turning market volatility into a full-blown crisis. Texas may continue to lead the nation in home building, but the path into 2026 is defined by danger. The evidence is clear. Prices are falling sharply in every major metro area. Builders are under pressure from heavy incentives, and the critical factors job growth and consumer confidence remain unpredictable wildcards. We are not merely riding economic mini-cycles. We are operating under extreme tension. The big momentum Texas claims is dangerously offset by the quantifiable risks of a systemic crash ahead.